Paying off your mortgage early could be a massive mistake, and I will show you why. So is it better to pay off your mortgage early, or is it better to make investments in the long term? The answer may shock you. If you're even thinking about paying an extra mortgage to pay off your mortgage early, congratulations to you. Most people cannot even think about it because they live paycheck to paycheck, and most Americans on average only save 4.6% of their gross income. So what's the smartest move for you? Let's break it down. In order to figure out what's best for you at this time, there is one consideration you have to make, and that's the most important thing, and that is, what is your interest rate? Is it 3%, 5%, 7%, 8%? Let's look at that. So here's what we are going to cover: how mortgage payments work, the math behind paying off early versus investing, 3 strategies to pay off a mortgage faster, and the other factors that may affect your payments. That is the inflation, your tax rate, your savings rate, and what you want from paying off your mortgage. Do you want freedom, or you just want to pay off early? So the first thing we have to understand is, how do mortgage payments work, and why is it that when you buy a house for $400,000 you end up paying almost $800,000 or $900,000 for that home when you include the mortgage payments? So whenever you make a payment every month, you have 2 payments, which is the principal and the interest. And of course you have tax and insurance, but those are variable. So let's focus on principal and interest. So if you look at the payments, let's assume you bought a house for $425,000 and your loan amount is $400,000 and your interest rate is 6.5% fixed. So if you bought this house, your total principal is $400,000, your total monthly payments is $3633, but that includes tax and insurance. But your mortgage payment, just principal and interest, is $25,2827. And if you look at the first payment in March 2025, assuming you bought the house right now, your principal is only $361.61, and most of your payment of $2166.67 goes towards interest. So that's a big chunk in interest that you will be paying every month, month after month for 30 years. This happens because the interest is charged on the remaining loan balance. So early payments mostly go to interest and not principal. One of the things you have to keep in mind is that up to 20 years of your payment, you are pretty much paying a lot more interest than you paying principal on your monthly payments. If you look at March 2045, your principal that you're paying is $1322 and your interest is still $1,206, and your principal balance is still $221,338 from the $400,000 principal that you had. Furthermore, let's look at the last payment that you make on your 360th payment in 30 years. February 2025, your principal payment is $2514.65 and your interest is $13.62. So until you hit the last 10 years, most of the payments are interest payment. Banks are making a lot of money and they are probably laughing at you when you send them those interest payments. In this example, at year 20, you still owe $221,338 even though you've paid for 66% of the loan's time period. Majority of the payment goes towards interest, not principal. Banks are rich. That's why so many people feel like they've never making a dent in their mortgage payments, and those payments keeps coming and coming. As I mentioned earlier, the biggest factor that you have to consider whether you want to pay off early or use that extra money to invest is the factor of your interest rate. Let's look at what happens, how much interest you pay over the life of your loan. If your loan amount is $400,000 and you have a 6% interest rate for a 30-year fixed mortgage rate, then your total monthly mortgage payment is $2528. If you notice that your total principal is $400,000, but the total interest that you're going to pay over the life of the loan is $510,177. In other words, that house that you paid $425,000, assuming you put $25,000 down and you had a loan amount of $400,000 when you bought it, that house, total house payments will be $910,177. That's a lot of money to pay for a house which you thought you paid $425,000. If you look at the same house with the same down payment, but your interest rate was 4% and not 6%, then the total principal of this house was $400,000. Your total interest payments that you pay over the life of the loan is $287,478. So the total loan payment, which includes your house that you paid, was $687,478, a lot less than $910,000 $200,000. And on this house at 4%, your payment is $1,909 principal and interest. And in that house with the 6.5%, your total mortgage payment, principal and interest was $2,528. That's why buying a house at a lower mortgage rate, and that's why people refinance when the rates drop, because over the life of the loan, you save a lot of money. And we're talking of hundreds of thousands of dollars. The higher your interest rates, the more you're giving away to the bank. Comment below on how high your mortgage payments are and if you would pay it off faster or if you would invest the difference. So now that you understand how much interest you may pay on your current home mortgage, there are many choices, and we are going to look at the example of Standard & Poor's, one of these options that you may have to invest. The S&P 500 has historically returned around 10% per year. After taxes, a reasonable return is 7 to 8% annually. If you look at the 5-year return in the last 5 years, the S&P has returned 15.36%. In the last 30 years, the average is about 9.67%. So let's call it almost 10%, which is a pretty good rate of return. And if you look at the chart over the last 30 years, and this is as of today, the S&P has gone up and up and up, and in the last 5 years has really gone up significantly. So you could have benefited, or you could still benefit should you decide to invest in S&P and similar investments. So let's compare mortgage rates with investment. If your mortgage rate is 3%, paying it off early means you're earning 3% on that money. But if you invest, you could be earning 7-8% or more, which is better. You can decide, because there's also a risk factor when you invest in stocks and bonds and mutual funds, etc. Let us look at $400 a month invested every month at an 8% return for 25 years versus if you were paying that mortgage earlier for $400 a month. So if you invest $400 every month for 25 years at a rate of return at 8%, your investment would be $365,942. If you were to invest the $400 per month mortgage overpayment, it'll save you way less. The reason is because when you keep investing money and it's growing every month, you have the compounding interest. So when you get a 8% return on your $400 a month versus paying $400 a month extra, your return is better when you are buying S&P in this example. Investing grows exponentially while mortgage savings are linear. If your mortgage rate is 3 to 5%, investing almost always makes more sense. But once rates hit 6 to 7%, the decision becomes closer, and some people prefer to pay it off for the peace of mind. Should you decide to invest, you may want to look at this chart, refer to it, and decide which way or which asset you would like to invest in. By the way, I'm not an accountant, I'm not a financial planner. This is just information. For any specific questions and when it comes to investing, you may want to talk to a financial planner before you make a decision. Let's look at 3 other factors that you may want to consider whether to invest or pay off your mortgage. These next 3 factors are crucial but often overlooked when deciding whether to pay off your mortgage or to invest the difference. The first one is liquidity and financial flexibility. Once you decide to put extra $300 a month, $500 a month, $600 a month, once you put that away, that money is gone and you do not have that money should you need for an emergency down the road because it's locked into your equity. So the money is there as equity, but it's not there in your bank account or in your stocks portfolio where you could pull the money out should you have an emergency. Before paying any extra payments, we always recommend, at least the accountants and the financial planners, they always recommend that you always have at least 6 months of emergency fund should you have a health crisis or you lose a job or if there's any kind of emergency. So having extra money in the bank is always recommended. The second thing you have to consider are your tax consequences. Taxes play a huge role in this decision and most people don't factor them in. If you are, let's say, 30 years old and you pay off your mortgage by the time you're 50, and if you're earning a lot of money at 50, you don't have any interest deductions. So that could be a factor. As I mentioned earlier, I'm not a CPA, so I won't get into the details, but there's always tax consequences because your taxes are deductible. If you have a rental property, then you have other depreciation and other tax benefits. So do talk to your accountant, but do consider taxes when paying extra mortgage. And the third thing you have to consider is the inflation's impact on mortgage debt. Here's something a lot of people don't realize. Your mortgage actually gets cheaper over time thanks to inflation. With a low interest fixed mortgage, inflation works in your favor. Paying it off early may not be the best move for you. Inflation reduces the real cost of your mortgage because you're paying back the loan with future dollars that are worth less. If inflation is 2 to 3% per year, your fixed mortgage, your fixed 30-year mortgage payment will feel cheaper over time. So we have talked about paying off your mortgage early and reducing your total interest payment. And we have talked about investments. But now I'm going to give you 3 examples on how you can pay off your mortgage faster and without breaking the bank? The first thing you can do is you can make bi-weekly payments. And I'll give you an example. So let's look at this chart here. So the way the bi-weekly payments work is you take your original payment. So let's say you had a principal and interest in our example on a $400,000 loan at 6.5% 30-year fixed rate. Our payment was $25.28, which you make every month. But if you take the same payment, divide that by 2, which is $12.64 per month, and let's say you pay on the 1st of the month and the 15th of the month. Same payment, not more. You're just paying every 2 weeks or bi-weekly. Then you end up paying 26 payments instead of 24 payments. So what happens is over the whole year, you end up paying one extra payment per year. And what is the significance of that is that on just interest, you will save $72,980 and you will cut off your mortgage time by 4 years and 1 month per this chart. The second way to do, and one of the most common ways to do it, whenever I sell a home, I tell my clients to start making extra payments, and most of them start making extra payments, maybe $50 to $60 to $100 per month in the beginning, and as they make more money, as they grow, they make more payments. But let's look at an example is, again, a loan amount of $400,000, 6.5%, and a remaining loan term of 25 years, because let's say you bought the house 5 years ago, and now you want to start making payments. So if you take your payments and start paying $400 every month extra per month every year, then you will end up saving a whopping $118,984 just in interest, and at the same time from your remaining 25 years you will pay it off in 6 years and 9 months earlier. That means you'll be paid off within 16 years and not the 25 remaining. So by paying $400 extra or $100 extra, it goes a long way and you save hundreds of thousands of dollars by using the simple techniques. I've been doing this for years and years, and I have a small mortgage payment remaining. The third way to pay off your mortgage earlier is, let's say you got a windfall, you got a tax refund, or you won a bonus, or you worked extra and saved a lot of money by the end of the year, or maybe grandpa, grandma gave you a bonus. So let's say that you have 25 years remaining and somehow you got a hold of $50,000, and instead of going on a vacation or shopping or blowing the money, you paid off $50,000 today. If you do that, then your interest saving by paying $50,000 one time over the remaining life of the loan, you will save $151,690, and you will cut off 6 years and 7 months from the remaining 25 years. If you can understand the power of paying off early, the power of paying monthly, you save thousands and thousands of dollars over the life of your loan. Keep in mind that the higher your interest rate, the more you will save when you make extra payments, and the lower your interest rate, the less you will save. But either way, your savings is a huge factor, not only in saving interest, but also in saving years of payments. So what is the final answer? Invest or pay off early? Well, that depends. If your mortgage rate is 3 or 4 or even 5%, it's better to invest. I have a mortgage interest rate of 3% and I've been paying extra, $300 extra a month. At the same time, I'm also investing every month, $500 a month, every month clockwork. So I'm getting benefits on the both sides. If your mortgage rate is 6%, 7%, and I know some of them paid 7.5% a few years ago, then it definitely makes sense to pay extra, whether it's $100 a month, $500 a month, $1,000 a month, whatever you can. Then you'll save a lot of interest over the life of your loan. Please also consider factors like liquidity, taxes, and inflation before deciding. Peace of mind is priceless. If being debt-free feels better to you, go for it. So what would you do? Please let us know in the comments below and share with us. And if you are trying to find out, there are other ways. Few months ago, I did a video on how to pay off your mortgage faster. In fact, how to pay it off 9 years faster. Please watch up to 7-8 tips in this video.